In your worst week, you experienced a $1 billion decline. What did you learn from it?
When you deal with large institutional funds, you tend to think in percentages and basis points. Depending on the size of your account, if you have a decent sized loss, you could be thinking, well, blimey, today I lost a car. Anyone working with any kind of data, the best trait to have is skepticism. Nearly every single error I've seen in my career has been because people have been overconfident.
In quant finance, what everyone talks about is the Sharpe ratio.
Here's the truth, there are no ideal performance metrics. A lot of people assume that there's this career path where you trade your own money, you get noticed by hedge funds and then they hire you. That almost never happens. You've got a much better chance of being hired by the world's best hedge fund from a non-target school with no qualifications than you have of getting in, having traded your own money.
Robert, thanks so much for doing this. You've said in past interviews that when working at Man AHL, the systematic hedge fund, in your worst week, you experienced a $1 billion decline. What was that whole experience like, and what did you learn from it?
Okay, great. It's a nice first question. This may sound surprising, but you tend not to think about things in terms of money, especially when you deal with large institutional funds. You tend to think of percentages and basis points. And so I think in terms of the kind of pool of assets within the fund that I was sort of responsible for as the head of the fixed income team, the loss was something like, I don't know off the top of my head, maybe it was like 10 or 11%. And so I thought, which obviously is quite a big loss in a week, 10 or 11%, but it was the most significant loss that, certainly I'd seen, in the sort of few years I've been running that particular part of the fund. But it wasn't until somebody who'd recently joined us from another fund, from a more of a discretionary fund, I was sort of having a weekly, one-to-one meeting with him, and I said, so how's your first week been? And he's like, he said, well, I can't believe it. Everyone's sitting around so calmly. We've just lost $1 billion. And I'm like, quick maths in my head. Oh yeah, we have. Yeah, you'll get used to it. I think that's one thing I say to people, is it was really helpful if you sort of abstract things as much as possible. So ideally, actually, in an super ideal world, you'd never look at your P&L, right? I'm guilty of, so I actually used to get a daily email with my P&L sent to me by my system when I started trading my own money, which kind of replicated what had happened in the institutional world. And I turned that off a few years ago. So now if I want to know what my P&L is, I actually have to go and look at it, sort of, and it's only if there's maybe something really big happening in the news and I'll be curious and think, oh, no, what the hell that's affecting my position, and I'll actually go and look. But ideally, you shouldn't look at your P&L. If you do look at your P&L, then definitely look at it in percentages rather than in actual number terms, because otherwise, depending on the size of your account, if you have a decent sized loss, you could be thinking, well, blimey, that's a car. Today I lost a car, and certainly I've in the sort of, crikey, nearly 11, 12 years now, I've been trading my own money. There have been days when I've lost a car. So it's a lot easier to sort of stomach that loss if you abstract it. And the other thing, of course, is experience. The first time you experience that kind of loss, is going to be harder than the second, third, fourth, 10th, 20th time you've experienced it. So I've been training for long enough now that I've seen some pretty hairy market events, everything from sort of the 2008 market crash, through to COVID more recently, through to, even more recently, the little wobble caused in April by the tariff announcements, to sort of be reasonably sanguine about seeing big losses and kind of expecting them.
I want to hear a little bit more about the culture at Man AHL. You did fundamental strategies there, and also the head of the fixed income strategies. I guess what's the culture at Man like, and how does it differ from other multi-manager hedge funds or quant trading firms in general?
Well, obviously, I'm speaking about the past, because although I am still in touch with people who work there, I haven't worked there myself for 10 years. So for all I know, the culture's completely changed. But I find it unlikely it's changed a lot, because I think, firms sort of carry the DNA of their founders within them. And the founders of AHL were three guys who did physics. So they had a very scientific view on the markets, and they were outsiders to an extent. So they weren't people who'd, so for example, in the US, a lot of the CTAs were started by people who used to work as pit traders. They came from that lineage. So they had a much more, I guess, visceral understanding of the markets, an intuitive understanding of the markets, and they less prone to perhaps taking an outside view and adopting a more scientific approach. I'm not saying that either approach is better. I think they each have their strengths and weaknesses, but the culture of Man is still going to be driven by those original founders. And I would say that certainly when I was working there, it was much more like working at a university than it was like working at at a bank, at an investment bank where I previously worked before. And I would imagine that that's true of a lot of quant hedge funds, to be honest. So I think certainly, if you're trading systematically, then there's less need to be constantly observing the markets. There's less need to be, reading the news and kind of thinking about the markets all the time. You could take a much more abstract and objective view, take a step back, most of the time, unless, something goes horribly wrong. And that leads to, so I used to say when I was trading in investment banking, I used to say that it was a job which was mentally challenging but not intellectually stimulating, whereas quant research, systematic trading is much more intellectually stimulating and mentally challenging, but you actually feel like using intellect rather than just having to do sort of maths under pressure effectively, which kind of describes sort of normal trading.
One of the things that's talked about a lot, in the media and financial news, and I see it a lot on just general quant finance YouTubers, is the fact that the best quants, and I guess it is no surprise, but I would like to hear from you. The best quants do come from that maths, the physics, heavy STEM scientific backgrounds. Why do you think that is? And why do you think that the people that come from those backgrounds tend to thrive in quantitative trading?
Um, I'm going to take a slight issue with your question, and the reason being is that I think that there's sort of a continuum of quant trading, and you can think of at one end sort of high frequency trading, and at the other end something like, well, more like the kind of low frequency stuff that I do, but also potentially if I go right to the really lowest frequency stuff I've done, which is implementing systematic global macro models where you're using economic data that's sort of coming around every month or every 3 months. They're almost completely different industries. So although from the outside you might say they're both quant trading, the actual methods being used have some similarity, but the skill sets can be quite different. So the sort of faster you're trading and the more high frequency trading, the more I think you can treat the market as an abstract object, in which case you don't necessarily need to have, say, a background in economics, or even necessarily a deep understanding of financial markets. You have to have an understanding of things like the rules of order books and things like that. But you don't necessarily need to have a lot of understanding of experience of trading financial markets. And therefore, you want to basically hire the people who are good at programming and good at analyzing data. And often those will be people from the kind of more sciencey sort of engineering backgrounds. And I think I would say actually you probably don't want to hire necessarily pure mathematicians. I mean, I have worked with pure mathematicians, but they're perhaps too abstract potentially. But having said that, the probably most successful quant firm ever is Renaissance Technologies, and they probably hire more pure mathematicians than anybody else. So what do I know? But the kind of end of the industry where I've been more working at, I think it's more helpful to have a more of a kind of a sort of broader experience. So, I always say to do my job, you need to be a competent programmer. You need to be, a competent sort of data analyst, data scientist, if you like. You also ideally want to be someone who's got an understanding of the markets and understanding of sort of financial and economic theory. And you don't have to be the best person in those. So I would be the first person to say, I'm not the best programmer in the world. I'm not the best mathematician in the world. But that sort of broader knowledge I think is more useful in the lower frequency, and particularly in the sort of macro, space that I used to work in. So that's why. And I guess the other thing is that there is a degree of path dependence in that people will look at firms that have done well and say, well, what kind of people do they hire? Okay. Well, so let's take a really silly example and assume that the most successful quant trading firm in the world only ever hire people who've done history at Yale. Well, you wouldn't be able to get a job in quant finance without having done history at Yale. Now, that's not necessarily going to prepare you to do the job. And people will no doubt come up with all kinds of ex post justifications saying, well, the reason why these Yale historians are so good in the markets is because they've got a good understanding of history, and that means they can understand the economic movements of the data and so on and so forth. But the truth is, it's probably just a lucky accident that a bunch of guys who do history at Yale got together and were successful in a quant firm. So I think there's a degree of that. I think there's a degree of people saying, well, the people who've done really well in quant have been, say, physicists, engineers, mathematicians, and maybe not so much economists. That doesn't mean there are loads of people who've done, say, economics, particularly sort of hardcore sort of econometric side of things, who'd be equally good in working in that environment. Historians maybe not so much, because obviously there is a sort of base level of mathematical knowledge that you need to have.
In your view, given that it's not all about STEM, scientific and I guess quantitative skills, if there was one trait that you think made someone excellent at conducting quantitative research for, let's say, low frequency strategies, the stuff you currently do, what would that trait be?
I'd say for anyone working with any kind of data, the best trait to have is skepticism. I think anyone who isn't skeptical about their results or their data or the markets or anything, or is going to potentially be in trouble. I think you need to be skeptical. Nearly every single sort of error I've seen in my career, or either by myself or other people, has ultimately been because people have been overconfident and have trusted in their backtest too much, or assumed that their data was clean when it wasn't, or overlooked the fact that they had forward bias in their prices or something like that. So I'd say skepticism is the most important trait, definitely. And I think that good people from STEM backgrounds who have learned sort of the quote unquote the scientific method will have that trained in them. But that doesn't, as I said, necessarily mean that good. Go back. I keep going back to history as my example, but good historians are skeptical as well. They'll read some source material and go, well, okay, this is one viewpoint. What is the evidence? What are the other viewpoints for it as well? So skepticism isn't necessarily a trait only found in the STEM subjects. So I definitely pick that one out.
No, 100%. Speaking of skepticism, one of the things I am skeptical of is the methodologies used to evaluate returns. So in quant finance, what everyone talks about, much more than absolute returns, is the Sharpe ratio. Mean return divided by volatility. And given that, let's say, I'll give an example. Long-term capital management had essentially a mean return that was very, very solid and very, very little volatility. And then, there's this one extreme event that essentially wipes them out. How is that methodology, how is the Sharpe ratio rather, a good measure of, I guess, how good a strategy is?
And if you forgive me for pretending to be a professor for one moment, it's the return minus the risk-free rate divided by the standard deviation. But anyway, that's not relevant to your question, but I just had to say that. No, that's an excellent point. And I think I haven't done checked, but from memory, I think even with that disastrous event that caused them to lose basically all their capital, LTCM still had a Sharpe ratio of over 3. So it does show that the Sharpe ratio is not necessarily an ideal performance metric. But here's the truth: there are no ideal performance metrics. They all have their weaknesses and their flaws, and the main weakness of the Sharpe ratio is it assumes that downside risk and upside risk are basically equivalent, and it implicitly assumes that returns have got like a normal distribution, whereas of course the returns are something like what I call an LTCM type strategy. So option selling, collecting sort of CDS premiums, or any kind of strategy where you experience lots of small gains and then occasionally you have a disastrous big loss. I could call an LTCM type strategy. So those are, negatively skewed fat left tail strategies, and it's not appropriate to use a Sharpe ratio to judge their efficacy. Having said that, the main issue that LTCM had was what economists call the peso problem. Basically, their data sets didn't go back long enough to see the outliers that would have killed them. Had their data sets done that, then even if then they would have probably, because then these guys weren't stupid. I mean, some of them were Nobel Prize winners, right? Then virtually any other performance metric that included those outliers would have shown them that they were using too much leverage and should have basically either done something else or sort of put up with a much lower return, but obviously, and then a sort of survival risk probability. So yeah, I use Sharpe. I think the thing about Sharpe ratios, of course, it assumes that you can use leverage. So for a futures trader like me, Sharpe ratio is my go-to metric for quick evaluation. But I'm currently writing a book for people who can't use leverage, and therefore Sharpe ratios is sort of secondary to a measure like, say, geometric return, which is a better measure for people who don't have access to infinite amounts of leverage. But kind of sort of hand waving proof, if returns are normal, then if you can maximize your Sharpe ratio and you've got access to infinite amounts of leverage, then you will also get the highest geometric return, basically. So it's fine to maximize Sharpe ratio under certain conditions. I use tend to use a more kind of nuanced sort of probabilistic view of return performance. So I'll look at something like the geometric return, but I'll look at it, using, say, a bootstrapping technique, and I'll use the distribution of those geometric returns, and I'll say, well, what's the likelihood that I'll get this geometric return given some conservative probability on that distribution, rather than just looking at the median, which is implicitly what you do when you just measure a geometric return or a Sharpe ratio. So again, that may have given the people at LTCM some warning that things were going to go bad. But if they didn't have those bad outliers in their data at all, then even that technique wouldn't have helped them. So the failure of LTCM is less a failure of a specific performance ratio. It's more of a failing of not having sufficiently long data to see the potential problems that you might have.
I want to talk a little bit about backtesting. I think backtesting is the universal way that people evaluate their quantitative strategies. Now, obviously, with a backtest, it's very, very easy to be tweaking all these different parameters, running all these different regressions, building all these different models. And as you tweak and tweak and tweak, eventually you'll find a graph that goes up and to the right. How do you avoid overfitting when you're building models to trade, and in your case, I guess, low frequency models, and how do you make that process robust?
Yeah, so I think what's helpful is to distinguish between two main types of fitting, and there's actually a third as well, but I'll discuss that only briefly. And those are explicit and implicit fitting. I think when people think about fitting and overfitting and backtesting, they focus very much on explicit fitting. An example of an explicit fit would be something like saying to the computer, right, here's 10 values this parameter can take, which of them has the best performance? And people are like, oh goodness, this is a very dangerous thing to do, so we need to do it properly. So we need to do things like split our data into in sample and out of sample, or use rolling or expanding windows, which is basically the same, except that the size of those windows adjusts dynamically over time as you get more data. And people can also do things like statistical things to make that more robust. So for example, rather than saying, oh, look, parameter 5 is the best out of all of them, you'd say something like, well, actually, statistically, parameter 5 isn't, so good that you'd only choose parameter 5. What you actually want is a portfolio of these parameters. And, yes, you'd give a slightly higher weight to 5 because it's performed the best, but that performance is statistically significant, so the weight's only going to be a little bit higher. And then maybe if you've got enough data at some point, you would actually allocate more and more to parameter 5. and less to the other parameters. But there's weight. So you can do all this good stuff, and this is stuff that you can program in your computer. And people focus very much on that. The danger comes when people do what I call implicit fitting. And implicit fitting, you gave a really brilliant description of it. Implicit fitting would work like this. You do all the stuff I've just described, and you pat yourself on the back, say I've done a great job, and I've not been a naughty person, and overfitted my strategy using insightful data, and I've been robust. And then you look at the account curve, and it's still not great. So you go, well, okay, rather than using these parameters, I'm going to use these other parameters instead, or I'm going to add an extra layer on top, or I'm going to take this market out because it does very badly, or there's a whole bunch of things you could do. And then you rerun the back test again using the proper explicit pat yourself on the back, I've done really well process, and you get a better performance, and you say, great, well, that's the one I'm going to use. But what you've actually done, of course, at that point is a form of fitting. It's not been done in the correct way or explicitly. It's been done literally by you swapping out one model and swapping in another model, but having done so importantly with full knowledge of the relative performance of those two models. And that's something that you couldn't have done if you had, in reality, if you didn't have access to future performance data. Especially in your time machine, you do that. So you do all this wonderful work with this, explicit fitting, with this optimizing of trading software. And then you just throw it all away by just going, yeah, model B is not as good. I'll choose model A instead. So the answer is to try and basically push as much as possible into the explicit fitting. And the way you do that, of course, is by saying, well, I'm going to choose from this set of parameters for model A and this set of parameters for model B, and I'm going to choose between those collectively. And effectively that will put, maybe model B is better, yes, but at the beginning of the back test, you won't know that. So only over time will you put more and more weight on model B. And therefore, as a result, your back test won't look as good, but it will be more realistic. And then there's an important point here, which is that a backtest serves two purposes. It tells you how a strategy would have done in the past, but it also tells you which strategy you should trade now. And it might be that doing your fitting properly or improperly, you actually end up with the same strategy because B is better, right? But importantly, you'll only be trading B exclusively if there's enough evidence to do it statistically. And also, you won't have unrealistic expectations of how B could have performed in the past. Because the problem is, if you've got unrealistic expectations of how B could have done in the past, you'll start doing silly things like saying, like LTCM saying, well, this thing does really well at really low risk. Let's just bump the leverage up because it'll be fine. Or this thing does really well. We can afford to trade it faster with higher costs, But if your past performance is unrealistically higher, then both of those decisions will have been stupid ones. So I think it is important to get a realistic backtest, even if you end up with broadly the same model as you're going to trade in the future.
How do you deal with alpha decay with your strategies? Because obviously things can't work forever. So what do you do about it?
If you're trading sufficiently slowly, then then forever is longer than my lifetime, so I don't care. So that's a trite answer. You can use statistics to look at whether on a statistically significant basis something has decayed. So if I was trading, high frequency data, I would expect my alpha decay to have a half-life of about a month and a half or 2 months maybe. Now, because the performance of the strategy is so high in high frequency, that means you can tell very quickly as using statistics whether the performance is degraded. So you can actually see that decay happening in real time. And then at some point you pull the switch and you slot in the next strategy that you've found or generated. Slow that process right down, and that decay process, the speed of trading I'm doing, that decay process potentially happening with half-life of 1 or 2 decades. Which means it's almost impossible to distinguish it from the kind of just general statistical noise around the performance of a strategy. So it's probably not even worth me bothering to check. Because for example, if you look at the performance of sort of basic trend following strategies over the last, say, 50, 60 years, they have shown a very gradual decay in performance. But I think it's still too soon to say you should turn them off completely. And, you know, they may have stopped working already. They may have not been working for 10 years, but because their performance is not that high to begin with, it's actually impossible to tell statistically whether that's the case. I mean, I'm just a big fan of using. I'm less sort of pure trend focused than a lot of funds are. So I'm a big fan of using a more of a, lots of other what I call trading rules as well to generate forecasts. So I'd be less exposed to a decay in the performance of pure trend anyway. But yeah, for me, by trading slowly enough, I can just kind of shrug and ignore it essentially.
What sort of strategies are you running in your personal account right now?
What do you mean by strategy?
So I know for a fact that, and you talk about on your blog, that you like to run a lot of trend strategies across many, many different asset classes. And I think you ran, like I don't know if I recall this correctly, but you ran some mean reversion stuff, some relative value stuff. I'd just like to get an overview of, I guess, what your portfolio currently looks like. Um, what does it look like?
So this is in basically alphabetical order, so it's not necessarily in any logical order. So I run something called an acceleration strategy. That's basically a trend on a trend. So if momentum's increasing, that's positive acceleration. If momentum's reducing, that's negative acceleration. If a market's falling, but it starts to fall less rapidly, that's positive acceleration. You get the idea. I've got something called asset trend, but that's basically where I form my trend signal on the whole asset class rather than just an individual market. So I say, are equities overall bullish, in which case I go along all the equities and vice versa. I've got a breakout signal that basically sort of sees where a price is within a range. And if it's near the extreme of that range, then it goes longer or shorter. I use carry, so that looks at the slope of the futures curve. See whether it's in contango or backwardation. I use what I call momentum, which is basically exponentially weighted moving average crossover. So that's momentum on the actual price itself. I've got a very slow mean reversion. So, the most asset prices seem to mean revert at longer time frequencies, also at shorter time frequencies, but I can't seem to get those strategies to work after trading costs. But yeah, over longer time frequencies. So basically, let's say the S&P has outperformed the FTSE 100 for the last couple of years, then I would go short the S&P and long the FTSE. I use something called normalized momentum, which is basically my normal momentum signal, but before I use it, I actually perform a risk normalization on the price series, so that makes the price series itself more normally distributed and gives a cleaner signal. I use relative carry, so that's saying, if the carry is higher in one particular part of the equities space, say I, go long that and short things with lower carry. Relative momentum again within asset classes, so I go long things that have gone up relative to other things. So that's like the opposite of the mean reversion signal, but obviously it's happening at a faster time frequency. And then finally I've got a skew signal, so that says if price movements have been extremely scary recently, so if there's been big sharp falls in prices, then I would actually go long those assets. Because generally speaking, the market pays a risk premium for assets like that. And I do that on both an absolute and a relative basis. That's my current suite of trading rules at the moment.
Wonderful. If you were speaking to someone young today, let's say he's a university student who wants to get into this world of quantitative trading, what advice would you give them? And I ask that question knowing that on one end, there's the standard internship into grad role into, trading firm / hedge fund. Or as you have, as you put out content for and run your own strategies, doing that independently, what would you do?
This is probably my least favorite question, to be honest. I feel really unqualified to give career advice for two reasons. Firstly, I'm relatively old, and it's been a long time since I've even had to do a job interview, for example. I think that my sort of path into the industry probably no longer exists potentially. And also, I think my own path into the industry was also very idiosyncratic as well. So it wasn't like a standard way of doing things. So yeah, I hate this question. I wrote a couple of blog posts on this subject, literally so that if anyone asks me this question again, I could just point them to those blog posts. So part of me thinks I should just say that, just go to the blog posts. I will kind of answer your question as a A/B question. So you said, basically industry or trading your own money. I think that, I think you're likely to be more successful if you can get a job in the industry, to be honest. I think the path of sort of bootstrapping your own capital and all that stuff is much harder. And the other thing is, I think a lot of people assume that there's this career path where you trade your own money, you get noticed by hedge funds, and then they hire you. That almost never happens. That's something like a 1 in a billion probability of happening. You've got a much better chance of being hired, by the world's best hedge fund from a non-target school with no qualifications than you have of getting in, having traded your own money, because it's just not a path that really exists. It's incredibly difficult. So if you are going to trade your own money, then I think you should do that with the knowledge that that's not necessarily going to be a route into the industry. So yeah, that's sort of my take on that, sort of one or the other. But yeah, for more general careers advice, please find someone younger and more qualified, or go to my blog where I have written down some advice.
The last conversation I had on this podcast, I was speaking to an ex-Jane Street trader, and I asked him, what are the conditions that Jane Street is able to create and culture that they're able to create such that they're able to hire the best people, make them thrive, and continuously execute and generate and execute on edge. Now, I asked this to you as an independent researcher. How are you able to find, all these inefficiencies in the market as, a one-man team? Is it difficult? And do you have a process for finding new strategies to fit into your portfolio?
Again, I hate to disappoint you. I'm probably the last person on the planet who should be answering this question. So the one reason I say that is I don't really believe that I found any quote unquote inefficiency of the market. I believe that basically all the money I make is from, what an economist would call risk premia. None of the things I've described to you are, they're only inefficient if you take a very narrow view of what market efficiency is. But they're not inefficiencies in the sense that they're literally public, like anyone can do them. The vast majority of the things I haven't come up with myself are things that have existed for a long time, that other people have done. So, and in terms of the pace at which I add new indicators to my system, I might add like one thing a year on average, if that, maybe less. And that's partly because I trade relatively slow systems. I've got this slow decay. There's not really any need for me to. So I'm in a completely different environment from Jane Street, for example. They have to keep generating new ideas. I'm also in a completely different environment from where I was institutionally, because working in institution, I had to justify my salary, right? So I had to generate new ideas, even if arguably they weren't necessary to an extent, because it's quite low frequency, so the alpha decay is quite high. So I don't necessarily believe that there's a lot of value in me personally, the way I value my time, in me doing lots of research and backtests. So the research I do tends to be more abstract, more kind of academic things, and or things that aren't related to new signals. So the main kind of innovation that I've made in my trading system over the last 10 years has been to do with the way that I handle the fact that my account size is relatively small, and I'm still able to trade over 200 futures markets with a very small account, with a relatively small account size. And that's the kind of one piece of research that has made the most difference to my trading. But it's got absolutely nothing at all to do with market inefficiencies or finding an edge or anything like that. I'm still using exactly the same set of forecasting rules that I was using before. So that, and in terms of my actual, if you look at most of my blog posts, a lot of them to do with portfolio construction and sort of fairly abstract academic stuff. And then if you said to me, well, do you use that in your trading? I'm like, well, not really, no. I don't. And the way I do my portfolio construction is actually quite crude because that works just as well as the more sophisticated techniques. I just enjoy the process of looking into those. If I was to spend more time doing backtests and research, I guess be prepared to have a very low strike rate. So I don't spend much time doing researching new trading ideas. I've implemented on average perhaps one a year. That's probably on the high end, to be honest. It might be one every 2 years. That's probably 20% of the ideas I've looked at. So my strike rate's about 1 in 5. If I was to spend more time doing it, my strike rate would be even lower. I don't think I necessarily come up with more than, more good ideas a year necessarily. So yeah, be prepared to fail, and it's better to fail than to overfit and come up with something that you think is good but actually isn't. Go back to what I said earlier, be skeptical.
When you were working, I want to go back, to clarify, I want to go back to, you working at Systematic Hedge Fund, Man AHL. When you were there, what were some of because as you've said, you had to justify your salary. What were the processes that took place such that people could continuously generate new ideas and execute on them?
Well, I can describe to you the sort of formal process by which ideas were reviewed. So, so one thing to say is that it's very much was very much a kind of collaborative environment compared to, say, like a pod shop, where people are very much in their own silos and they literally don't want to leak any information to the desk next to them because they're effectively competing with each other. That wasn't the environment that we tried. So when I was working there, it was encouraged. So, for example, we had a research library, and any research report that was written, anyone from the kind of quant team could go and read that, and actually, we sort of that was the important thing that we did, because one of the things you don't want to do is to have people sort of redoing stuff like, oh, we looked at this 5 years ago. Did we? Well, the guy that did it's left. So how do we know? Well, actually, if you go and just like as if you were an academic, you're going to write a new paper, the first thing you do is review the existing research. Similarly, you'd go and review the existing work that had been done. Even if, firstly to check you weren't redoing something. Secondly, to check that you could build on earlier stuff that people had done as well. So that was one thing that was very important. The other thing that was very important in terms of collaboration was a sort of formal system of review. So if someone working with me is working on a research idea, I'd obviously be regularly reviewing what they did. But then at some point that would go to and it would be just like in an academic environment, people would present their ideas and we'd have seminars and people would say, well, look, here's this idea I've got. And the people that showed up for that seminar wouldn't necessarily just be quants. They could be traders. They could be people in the middle office who still would have valuable things to say. Like, for example, well, this is lovely, but you can't legally trade this, right? You wasted, so rather than we're wasting that person's time further, you're able to get input from other parts of the firm in a sort of relatively informal way. And then finally you'd get to the point where you'd be like, yeah, this really looks good. And you'd write it up as a formal proposal to implement a new trading strategy. And then there was a formal process by which a series of people like, the head of risk and the CIO had to kind of, they basically had the right of veto on these things to say, yes, this is fine, or no, this is a terrible idea because of X, Y, or Z. Ideally, you wouldn't get any ideas rejected at that point because that would be an indication you hadn't done your homework, and you'd never want to be in that position. So yeah, it was there was a degree of formality and a degree of rigor, which some people grumbled about, but I think it's important, if you're going to have a collaborative environment, to get everyone's input both on an informal and a formal basis, and to make sure that there's no kind of obvious flaws, because we did make mistakes. There were strategies that were implemented that shouldn't have been implemented, and I think it's in retrospect there were things that could have been done to stop that happening. So I think those processes made sense.
Do you think that the huge multi-managers like the one you worked at, like Citadel, like Millennium, do you think that we're going to go through a consolidation where all the money will, or most of the money that's going to be allocated by, institutions or even retail guys is going to flow to them because they've gobbled up all the talent. I mean, continuing to gobble up a lot of the talent, and, they can essentially buy all the data and essentially continue to generate more edge and, enhance their own. Do you think that capital will consolidate at those top quant shops, and that smaller players are going to have a much harder time generating alpha? I'd love to hear your thoughts.
I mean, just a slight correction. I'm not sure I'd put Man AHL in the same bucket as Citadel Millennium. So they're not a pod shop. So they're a publicly listed company that owns a bunch of hedge funds essentially. And none of those hedge funds are pod shops. So it's very different from the setup where you've got, dozens and dozens of individual teams of 3, 4, 5, 6, 10, maybe 10 people. As I said, working very independently. It's the environment where you've got 100, maybe 120 people. Effectively, it's not really a pod. It's 120 people. It's not really a pod anymore, right? And that's roughly what I think the kind of front office headcount of AHL is. I don't know for sure. So, and I think in terms of the gobbling up process. So I guess you're likely to, if your strategy is profitable, you're going to make more money at Citadel or Millennium than you would at, say, Man AHL. Because they're because of the pod structure, the compensation structure, you're going to take home a bigger percentage of your revenue. There's much more of an eat what you kill setup. I think people, different kinds of people are motivated to work at places like that versus places that are more collaborative, academic, open, places like Man AHL. So for example, I would personally never work anywhere. Well, I'm hoping never to work again, to be honest, but we'll see. Not full time anyway. My DMs are open for potentially part-time offers. But I would never consider working at a pod shop or place like that. And believe me, I probably every couple of weeks get a job offer from one. So it's not like the opportunity is not there. Because that kind of environment just doesn't interest me. I definitely enjoy working there. I think people who are, yes, purely motivated by money would potentially just go and work for Citadel and Millennium, and maybe also because there's more of a degree of freedom. You don't necessarily, if you're a discretionary trader and you've got a good trading idea, you don't need to go through 3 committees. You can just do it, right? And it's up to you. It's on your head. If it makes money, great. If it loses money, then you're gone. That's the way it works. That kind of environment has zero interest for me. And I think there's a parallel here with what's going on in the AI world in terms of hiring top developers. So I think apparently top AI people are being offered amounts of money that even a trader would find obscenely large. Like people are saying like 9 figures and stuff. I think there are probably AI researchers who would be like purely motivated by money, who'd happily jump ship and work anywhere. But there are others who will stay where they are purely because they find the culture and the environment much more conducive to, and they're probably being paid enough money. Like after a certain point, like to most people, like after a certain point, money doesn't really, the extra 10, 20 million doesn't really matter, right? So it doesn't become, some people, yes, will want that extra money, and that's fine, but they're not necessarily the people you want to have working for you, to be honest. I think the people you want working for you are those for whom money is a secondary consideration. And I think that's true in quant trading as much as I think it's probably true in AI.
Wonderful. I think that's a great place to leave our conversation. Thanks a lot. Best of luck with everything. And for everyone watching, I'll put a link to all of Robert's books. They personally would inspire me to get into quant finance. Thanks a lot, Robert.
But yeah, no, it's
No
been
worries.
fun, Ethan. Thanks very much for inviting me on.
Thank you very much, Robert. All the best.